Now, still in East Africa, on October 25th, Tanzania will be holding its next general election. This is a country, remember, that's home to natural gas reserves of about 55 trillion cubic feet, and Tanzania aims to become a net exporter of that commodity. Since 2007, and this is an interesting trend here, the country's also consistently attracted a lot more foreign direct investment on an annual basis than the region's biggest economy, Kenya. So, is all that cash just about oil and gas, or is there more to Tanzania's economy? That was part of my conversation with StratLink Africa's Julians and Amboko earlier on, which included a look at how sub-Saharan African Eurobond issuers are coping with an increasingly stronger dollar.
I think the conversation now we should be having is whether that the debt management and debt sustainability strategies are in tandem with the realities on the ground. I think as far as the pinch goes, we are already feeling it, if you look at the yields, for instance. So the policymakers now are being sent back to the drawing board to see exactly what's the way forward. Are
we likely to see more instances, perhaps, of countries like Nigeria, who essentially went partly all the way with capital controls? Are we likely to see a lot more of that in sub-Saharan Africa?
Well, it's a tricky position for most governments, I would say. We know that, for example, Zambia right now is deliberating on whether to have FX controls or not. So really, it's neither here nor there as to which direction each government is taking. But I think we are all taken back to the basics and to see our debt management and how it stands.
Right. Finally, let's focus on regional FDI. Every single time we talk about this subject, especially in East Africa, Tanzania tends to get a lot more foreign direct investment than Kenya, which is the region's largest economy. What explains that dichotomy?
Well, Tanzania, as you would know, has vast gas reserves, and most importantly, the IEA puts it at about 55 trillion cubic feet of gas reserves. And if you look at the trend of gas reserve, the LNG prices between 2000 and 2013 has been on the uptrend, and significantly so, and largely driven by high demand from Southeast Asian economies. So that factor has really been a key driver. But now that we have seen growth faltering in markets like China and Brazil, etc., it's highly unlikely we could see the kind of FDI we have seen in the past this year. So
it would be fair to say that most of that flow has purely been just about oil and gas, and not really things like financial services, retail and so on.
In the Tanzanian case, I would anticipate it was largely more on the reserves.
Right. The petroleum bill, this landed in the hands of Tanzanian legislators just before the dissolution of parliament. They've got elections coming up in a couple of weeks as well. Is the dispute around that particular piece of legislation a net negative for investors looking at Tanzania?
I would think so, Ramah, because especially coming just before the election, it has really thrown into disarray the kind of political environment there is in Tanzania. We know already that the constitution review was deferred, and so now the tabling of the bill just before the dissolution of parliament, which has been widely taken to be a scheming move by the opposition, has really put people in a dicey position, if I may say. Investors looking into Tanzania are a bit uncertain as to how things are going to evolve in the next couple of months.
But looking at Tanzania as an investor, I mean, what would be the rationale for the government of the day to essentially bring this bill, which is important to the economy as a whole, just before legislators essentially go off on recess?
It's a tricky one, Ramah, I would put it that way, because we would anticipate it would have taken a lot more time, especially for the kind of gravity that bill holds. There would have been a lot more room for deliberation. But why it was tabled as such by the ruling party is really not for us to tell.